Two companies that everyone thinks they have figured out, AMC Theaters and GameStop. And it's about as contrarian as it gets. I am looking at two radically different financial setups, one drowning in debt, the other swimming in cash. But my thesis is that both are mispriced to an absurd degree. Exactly. Let's start with AMC. The narrative is straightforward, distressed, drowning in debt, a relic of the past. Right? The number everyone points to is that $8.2 billion in debt. They see it as a giant anchor dragging the company down. But my analysis calls AMC a massive convexity play. It's basically saying that instead of a debt trap, that huge debt pile is actually rocket fuel, which sounds crazy. It does. So I need to unpack two core ideas here: stub value insanity and muscle math. Let's start with the stub value. Let me run the numbers. Okay, so as of mid-February 2026, AMC's total market cap is floating around $632 million. But to find the stub value, what the market thinks the actual operating business is worth, you have to back out their liquid assets. And they have cash. A good chunk. Roughly $428 million in cash. Plus, they have a stake in Hycroft mining worth another $27 million. So in my view, if you take the market cap of $632 million and subtract the cash and gold, which is $455 million, what's left over? About $176 million. That is the stub. The market is valuing the entire global theater chain, all the screens, the leases, the brand, the popcorn machines, at $176 million, for a company projecting $5.3 billion in revenue for 2026. Exactly. It pushes the price-to-sales ratio to something like 0.03. You are buying billions in revenue for pennies. The business is basically priced for bankruptcy. But the skeptics would say it's priced for bankruptcy because of the debt. You can't just wish away $8 billion. And that is where muscle math comes in. This is the convexity argument in my analysis. Think of the company like a house with a huge mortgage. The mortgage is fixed, it doesn't change. But your equity, the part you own, is a tiny slice. Right, so if the value of the whole house goes up just a little bit, your tiny slice of equity gets a massive boost. My analysis lays out a scenario where if AMC's total enterprise value rises by just 10%, maybe a few hit movies, a slightly better quarter, that 10% gain is nearly $1 billion in new value. And since the debt is fixed, that value flows straight to the equity. Precisely. And since the equity is currently only valued at $600 million, adding $1 billion to it causes the stock price to explode. We're talking a 400% or 500% move from a small linear change in business value. That's the lever. That's the lever. It cuts both ways, obviously. It's high risk. But my analysis points to smart money positioning for this, specifically Pentwater Capital. They own about 10% of AMC, but here's the kicker. They also own 50 million shares of Warner Brothers. It's an ecosystem bet. Exactly. Warner Brothers needs theaters to monetize blockbusters. AMC needs content to fill seats. Pentwater is betting on the transaction between them. They see that $176 million stub value as a glitch in the matrix, waiting to be corrected. So you have AMC as the high-leverage muscle math play. But then if I flip the page to GameStop, it's the complete inverse, total opposite. If AMC is the lever, GameStop is the bunker. People still call it a meme stock, but the balance sheet tells a completely different story. It's a fortress. GameStop is sitting on $4.6 billion in cash. And the most important part, zero debt. In this interest rate environment, that is a war chest. Put that in perspective with their valuation. The market cap is hovering around $10.5 billion. That means almost half the stock price, about 34% to 40%, is backed dollar for dollar by liquid cash. This creates what my analysis calls a cash floor. It puts a hard bottom on the risk. Right. If you strip out that $4.6 billion, Wall Street is valuing the actual business, the brand, the logistics, the stores, at only about $5.9 billion. It's trading at something like 0.6 times its book value. Compare that to the rest of the market. I mean, look at the AI darlings. Nvidia or Tesla trade at 13, 20, sometimes 30 times book value. The market is overpaying for future growth promises on one side, and on the other, selling GameStop for less than the stuff in its vault is worth. But why hoard the cash? That's the big question. That ties into my macro trap thesis. The argument is that passive indexing, ETFs buying the biggest stocks automatically, has broken price discovery. It's created a bubble at the top. Larry Cheng, a GameStop insider, has been warning about this. He points back to the capital rotation of 2008. When liquidity dries up, cash stops being boring and starts being ammunition. Exactly. In a crash, even giants get crushed. Amazon fell 61% in 2008. But if you have $4.6 billion in cash when everything goes on sale, you aren't just surviving, you're shopping. It's the Berkshire Hathaway model. It is. Warren Buffett didn't get rich spinning yarn at a textile mill. He used the mill's cash to buy insurance companies. The thesis here is that Ryan Cohen has done the same thing. He used the meme frenzy to raise billions, parked it in government bonds, and is now just waiting for the asset bubble to burst. So the dying brick-and-mortar store is a smokescreen. It's a distraction. GameStop is effectively a holding company now, a SPAC with no deadline. We're even seeing institutions like Morgan Stanley waking up to this. They just increased their position by nearly 30%, adding over 600,000 shares. That's not passive, that's an active bet on this rotation. In my opinion, the current market valuations of AMC Theaters and GameStop GME appear to represent two distinct but equally extreme distortions of fundamental value, creating a rare barbell opportunity for contrarian investors willing to look past the prevailing meme stock stigma. On one end, AMC exemplifies a classic convexity play, where the market's fixation on the $8.2 billion debt load has compressed the equity valuation to a point of absurdity. Valuing a global theater chain generating $5.3 billion in revenue at a mere $176 million stub value, after backing out cash and assets, suggests a pricing model that assumes imminent liquidation, ignoring the operational reality of a recovering industry. The muscle math concept highlights how this depressed equity slice acts as a potent lever. Even a marginal 10% increase in enterprise value, driven by a slate of blockbuster hits or improved margins, could mathematically force a 400 to 500% explosion in the stock price, simply because the debt is fixed while the equity absorbs the surplus value. Conversely, GameStop represents the ultimate defensive hedge or bunker play, where the market is severely discounting a fortress balance sheet. With $4.6 billion in cash and zero debt, nearly 40% of GME's market cap is backed by liquid capital, creating a hard cash floor that limits downside risk in a way rarely seen in retail stocks. The market is pricing GME as a dying brick-and-mortar retailer, trading at approximately 0.6 times book value, while ignoring its transformation into a de facto holding company or SPAC. If the macro trap thesis holds true and the passive indexing bubble bursts, GME's massive cash hoard transforms from a passive asset into aggressive ammunition, allowing it to acquire distressed assets at cents on the dollar, effectively mimicking the early Berkshire Hathaway strategy. Ultimately, the market seems to be pricing both companies for death, AMC via bankruptcy and GME via irrelevance, creating a scenario where continued survival, let alone success, could trigger a violent repricing, as financial gravity reasserts itself against these deep distortions.